In recent days, global financial markets have experienced a marked upswing fueled by growing optimism over renewed trade discussions between the United States and China. Currently unfolding in London, these negotiations aim to build upon the tentative progress achieved in Geneva, where both nations agreed to a temporary rollback of tariffs. This development signals a cautious but significant thaw in what has been a fraught and protracted economic standoff between two global superpowers. The backdrop of this diplomatic effort is a multi-year trade conflict that has profoundly disrupted international commerce. Spiraling tariffs and export limitations have rattled global supply chains, injected uncertainty into investment decisions, and cast a shadow over growth prospects worldwide. The recent 90-day suspension of tariffs offers a precious breathing space, enabling negotiators to tackle complex, thorny issues that go well beyond the surface-level tariff barriers. At the heart of these talks are key figures such as United States Treasury Secretary Scott Bessent, Trade Representative Jamieson Greer, and China's Vice Premier He Lifeng. Their challenge extends beyond pausing tariffs. They seek to untangle structural knots involving intellectual property rights enforcement, technology transfers, and strategic resource control. Rare earth minerals, indispensable for modern electronics, green technologies, and defense applications, are a particularly sensitive point. With China holding a commanding position in global supply chains, financial markets have reacted favorably to this diplomatic momentum. The Hang Seng Index in Hong Kong climbed 1.4%, Japan's Nikkei increased by 0.9%, and technology stocks in the United States rallied noticeably. This enthusiasm reflects investor hopes that a détente could restore predictability to supply chains and improve corporate earnings, especially in sectors hardest hit by the trade conflict. Nevertheless, beneath the surface optimism lies a current of caution. The tariff hiatus is temporary, slated to expire in mid-August, and deeper disagreements remain unresolved. Core issues like intellectual property protections and export controls, deeply entwined with national security concerns, could reignite tensions if left unaddressed. Investors remain watchful, aware that a breakdown in talks could trigger renewed volatility. Parallel to these trade negotiations, market watchers are focused on upcoming economic data, especially inflation figures from the United States and policy decisions from the Federal Reserve. The central bank's stance on interest rates will critically shape market dynamics. A tightening bias might dampen risk appetite, undermining gains from trade optimism, whereas a dovish approach could further buoy investor confidence. Looking forward, a successful and enforceable agreement would be transformative. It would reduce trade frictions, stabilize fragile supply chains, and bolster global economic growth. Moreover, it could open doors for broader cooperation on pressing global challenges, including technological innovation and climate change initiatives. Conversely, failure risks prolonging economic uncertainty and escalating geopolitical frictions, with ripple effects beyond just trade. In sum, the ongoing trade talks represent a pivotal crossroads. The recent market rally underscores tentative hope, yet the road ahead is riddled with challenges. The world's eyes remain fixed on these negotiations,